Imagine winning the biggest, riskiest bet of your life, and then getting kicked out of the winner's circle for being too successful. That is exactly what is happening to Michael Saylor and MicroStrategy. He bet the entire future of his company on Bitcoin, was called reckless, irresponsible, and insane, and then he was right. Yet now, after winning the Bitcoin bet, his company is being pushed out of one of the most important stock indexes in the world, the Nasdaq 100, and faces exclusion from other major indices that control billions of dollars. To understand how we got here, you have to know who Saylor is and what kind of company he built. MicroStrategy was founded in 1989, and for decades, it was a classic, almost boring business intelligence software company that helped corporations analyze data. Nothing flashy, nothing revolutionary, just a steady tech business that survived the dot-com bubble and CC accounting scandal in 2000 years of slow grinding existence on the stock market. By 2019, MicroStrategy was not a hot growth stock. It was one of those forgotten mid-cap tech names that index funds hold because they have to, not because anyone is excited. And then 2020 happened. A pandemic, aggressive money printing, interest rates cut to zero, and trillions of dollars flooding the system. Saylor looked at his company's balance sheet, looked at the Federal Reserve, looked at inflation, and reached a brutal conclusion he repeated over and over in interviews. Cash is a melting ice cube. Holding billions of dollars in US dollars, in his view, meant slowly committing corporate suicide. So he went searching for what he called a superior Treasury Reserve asset. Gold was too old. Real estate was too illiquid. Bonds were guaranteed losers after inflation. Bitcoin, the hardest, scarcest digital asset ever created, looked to him like the only lifeboat. In August 2020, MicroStrategy announced it had bought its first chunk of Bitcoin as a primary Treasury Reserve asset. That was not just a small hedge. It was a statement of war against the traditional way corporations manage cash. Over the next few years, Saylor doubled, tripled, and quadrupled down. He used company cash to buy more Bitcoin, then issued convertible bonds, then straight debt, then even sold more equity, using Wall Street's own tools to vacuum up more BTC. By 2025, the company held hundreds of thousands of Bitcoins, controlling roughly 3% of the entire Bitcoin supply, a stash worth tens of billions of dollars at peak prices. At that point, MicroStrategy was on paper still a software company, still filing 10 kiloseconds, still selling business intelligence tools, but in reality, its fate rose and fell with one thing: the price of Bitcoin. When Bitcoin crashed in 2022, MicroStrategy's stock was crushed, and critics screamed that Saylor had turned a respectable software firm into a leveraged casino. When Bitcoin roared back, hitting 6 figures per coin, MicroStrategy's share price exploded, outperforming traditional tech giants and embarrassingly beating the very index funds that once treated it like a forgettable mid-cap. The Bitcoin bet as a pure financial strategy worked. By 2025, the company was generating massive unrealized gains, earning a yield on its Bitcoin through various arrangements, and Saylor looked less like a lunatic and more like the one CEO who actually understood what was happening to money. And that is exactly when the trouble with the indices began. The Nasdaq 100 is not just a list. It is an index of 100 of the largest non-financial companies listed on the Nasdaq exchange. Names like Apple, Microsoft, Nvidia, Amazon, the giants that define modern technology. Billions of dollars flow through ETFs and index funds that are legally or structurally required to track that index, which means if you are in the club, huge pools of passive money are forced to buy and hold your stock, and if you are kicked out, those same funds are forced to sell you, even if they personally like your company. Most people think getting removed from an index is about size, like your market cap fell too far, but there is another layer: classification and behavior, the question of what your company actually is. And this is where Saylor's strategy runs straight into the wall. Officially, according to standard industry classifications, MicroStrategy is an application software company. That label is exactly what lets it sit inside a non-financial index like the NASDAQ 100, which is designed to track operating businesses, not banks' funds or investment vehicles. But if you stop reading the label and look at the numbers, the picture is completely different. At times, more than 80 or 90% of MicroStrategy's market value has been directly tied to its Bitcoin holdings, not to the revenue or profits of its software products, and its stock often behaves like a leveraged Bitcoin ETF, rising 2 to 3 times faster than Bitcoin in bull runs and crashing harder in bear markets. Index committees see this and start to worry. They are supposed to deliver broad, diversified exposure to tech and growth, not hide a massive, concentrated Bitcoin bet inside a basket that millions of conservative retirement accounts hold. Imagine you are a teacher or a nurse buying a simple NASDAQ 100 ETF for your 401k, thinking you own a slice of the best tech companies in the world. What you actually own, without knowing, it is a highly volatile Bitcoin proxy, because one of the software companies has secretly turned itself into a huge digital asset vault. Regulators hate those kinds of surprises, and index providers know that if something goes horribly wrong, they will be the ones answering questions. So the red flags start stacking up. First, MicroStrategy's business reality no longer matches its sector label. Second, its volatility introduces risk that is supposed to live in crypto land, not in blue-chip tech indexes. Third, as new rules from providers like MSCI and others are discussed, companies whose balance sheets are dominated by digital assets begin to be treated like investment vehicles rather than operating firms. In fact, in late 2025, MSCI proposed rules that would reclassify any company with more than 50% of its assets in crypto as effectively an investment company, making them ineligible for many mainstream equity indices. Analysts estimated that if those rules hit MicroStrategy and similar firms, it could trigger billions of dollars in forced selling, as passive funds are required to dump their shares. This is the quiet battlefield where Saylor finds himself. On one side, he argues, we are a software company with a modern treasury strategy, insisting that holding Bitcoin is no different, in principle, from a company holding large amounts of cash, gold, or foreign currency. On the other side, the index committees, ETF providers, and regulators look at his balance sheet and say, no, you are functionally a Bitcoin fund wearing a software costume. From Saylor's point of view, it looks and feels like punishment for being early. He embraced Bitcoin before Wall Street ETFs were allowed. He used a public company as a vehicle for long-term Bitcoin accumulation. He sat through brutal drawdowns while everyone mocked him. And then when the thesis finally pays off, the traditional system moves the goalposts and says, you are too different. You do not belong here anymore. This is what makes the story so strange. Being kicked out of the NASDAQ 100 is not happening because MicroStrategy is failing, but because it is succeeding in a way the index was never designed to handle. The consequences are not just symbolic. When a company is removed from a major index funds that track it have to sell. Pension funds that are limited to benchmark constituents have to adjust, and that mechanical selling can put real downward pressure on the stock, at least in the short term. It can also shrink liquidity and make the stock more sensitive to the mood of a smaller pool of active traders. For everyday investors, this reveals an uncomfortable truth about passive investing. When you buy an index, you are not buying some neutral slice of the universe. You are buying into a set of human decisions about what counts as a normal company, what kinds of business models are acceptable, and where the line is drawn between innovation and too risky. We have seen versions of this play out before. Early railroad companies were once considered speculative bubbles and kept out of respectable portfolios. Radio and television companies were treated as fads. Early credit card businesses were viewed as dangerous because of unsecured lending. And more recently, internet stocks in the late 1990s were first ignored then, overhyped, then aggressively punished as not real businesses after the crash, even though some of them went on to become trillion-dollar giants. History shows a pattern. The first wave of disruptors rarely fits the neat categories built for the old world. And rather than rewriting the categories immediately, the system often pushes them to the edges, labels them speculative, and only later, after they have either died or become too important to ignore, lets them back in as normal. MicroStrategy is now in that in-between phase, too intertwined with Bitcoin to be treated like a regular software firm, too corporate and regulated to sit comfortably next to pure crypto exchanges and meme coins, too successful in its bet to be dismissed, but too unconventional to be quietly absorbed into the index machine. So when you hear that Michael Saylor is being deleted from the NASDAQ after winning the Bitcoin bet, what you are really seeing is a clash between two worlds. One where a CEO can use a corporate balance sheet to adopt a new kind of money at massive scale, and another where index rules built for the old world are trying to protect everyday investors by excluding anything that looks too much like a rolling financial experiment. Saylor proved that a corporate Bitcoin strategy can generate enormous returns. The index system is now proving that there are informal boundaries on how far you are allowed to push that strategy before you lose your automatic seat at the table. In the long run, Bitcoin itself does not care whether it is held by an ETF, a software company, or a million individuals. It just keeps producing a new block every 10 minutes. Saylor will likely keep holding because his whole public persona is built on Bitcoin forever. But for you, the investor watching all this from the outside, the important lesson is not just about Bitcoin. It is about power. When you invest through traditional structures, ETFs, indexes, benchmarks, you are not just betting on price movements. You are betting on the rulemakers staying comfortable with the companies you own. And sometimes, as this story shows, winning too hard at a new game is exactly what gets you removed from the old one. Subscribe to this channel for more financial mysteries content. Thank you for watching.